Yes, and I've talked about this during the pre-interview here that if you look at the market, people, according to the Austrian School of Economics, the marginal utility of the prices of things, two people have to decide what that price is. And but that's fine. But the thing is, the market, the entire global market is based on margins.
But you have a unique way of relating gold to the price of energy. And really everything, as you're going to show today, is based on energy. So we have a bunch of charts here that we're going to go over today. So this is probably best viewed on YouTube, but we'll try to do our best to explain what is contained within all these charts. So with the first one here, Steve, what are you seeing and why did you want to bring this one up?
Well, I'm using Harry Dent Jr. as just an example. There are many out there who either have bullish or bearish forecasts for gold. And what they do is they tend to look at gold and use different metrics, whether it's debt, whether it's the money printing or the money supply, or technical analysis like the cup and handle formation. Or some people use, the funny thing is they throw goat entrails against the wall. They try to see where, what the pattern's going to be. But back in 2019, Harry Dent was famous for putting this chart out. And he says that if we look at this chart, it shows the chart of gold going up to its peak in 2011. And then it's been falling. And then he says it didn't break above 1525. And so his forecast, it would go back in 2020, 21 to 1,000, and then maybe 700. And then possible it would go back to its bubble origin, which started in 2005 in the 400 to 450. And now and I'm just using Harry as an example. I respect his work, but I disagree because Harry is forecasting gold in an energy vacuum. And unfortunately, a lot of analysts just don't understand what's happening with energy and what it costs to produce gold. Because if you can't make a profit producing gold, then there is no gold supply. So we have to understand what it costs to produce gold. So if gold ever got down to 450, I can assure you that there isn't one gold miner, maybe one small gold miner that can produce gold for $400 an ounce. The entire gold industry would go bankrupt. So this is typical that I see continuing in the precious metal community, as well as other analysts. A lot of the mainstream analysts just look at gold, not how it's impacted by the oil price and what it costs to produce it. And that's how I differ from many of these analysts.
Mm-hmm. And, it just brings to mind that old saying of the cure for low prices is low prices and the cure for high prices is high prices, right? So it really brings to mind the idea that if it is not advantageous enough to produce gold at $400 an ounce, nobody's going to start producing gold. And that will make it therefore exceedingly rarer to be able to find gold, driving the price up, right?
Yes. And, I've talked about this during the pre-interview here, that if you look at the market, people, according to the Austrian School of Economics, the marginal utility of the prices of things, two people have to decide what that price is. And but that's fine. But the thing is, the market, the entire global market is based on margins. Whatever it is, whatever good or service, if a company is selling something and they cannot make a profit margin, or an industry, then that good cannot be delivered to the market. So what is the foundation of our global economy is what it costs to produce things. Mm-hmm. And then there's a margin. And there has to be a margin for these companies to continue producing things and delivering to the market. So gold has a margin, silver has a margin, everything has a margin. Some margins are higher, some margins are lower, but that's how the markets work. But unfortunately, a lot of people want to forget these margins.
Mm-hmm. Yeah. And again, it just goes back to thinking about how many drivers there are for all of these different prices. And if you try to take everything into account, it becomes exceedingly complex, obviously. But when you think about the energy component being so critical to every single piece of the economy of producing any good, it seems like one of the most important and, let's say, hardest to forget, right?
It is. And I think I tried to continue to clarify, it's not just the energy, the diesel, the liquid fuel that the gold mining industry uses, or the electricity that is powered by natural gas or coal that actually processes the ore and refines it. That's just one aspect. You've got the labor, which is a big part, and that's labor from the people that are doing the work, and the management is a high form of labor. They get paid more. And then there's all the materials and the mine, and all of that actually is a combination of energy spent and burned through the entire process of building the mine, or the materials that it uses to produce gold. All those materials are the combination in the entire supply chain of energy that was consumed. And so when you understand that the good that is being sold, the major component, when you add it up to the entire supply chain, is energy in all forms and stages. So that's why the energy is the number one driver of the economy, and it's the number one factor that determines the prices of things.
All right, Steve, let's move on to the next chart here. We're going to get to margins and, a couple news stories and stuff later in the interview. But what is this, when we think about the growth of money supply, how did that drive gold prices?
Well, we could see here, even though the money supply has been going up kind of at a steady level, we're not seeing big bumps in the gold M2 money supply, which is in green, except when we had the pandemic shutdown. And so if you look at the gold price in 2020, it's going up similar to the M2 money supply. But unfortunately, but not unfortunately, a lot of that M2 money supply ended up in the big banks. They purchased treasuries with that because that's what they're supposed to do with cash that goes into the big banks. And then what did the Fed do? The Fed took those treasuries and put it on its balance sheet. So a lot of that M2 money supply is held as a prisoner by the Federal Reserve. So it can't bounce around in the market. So it's gone. But if we look back in 1970s, we could see the gold price had two bumps. From 72 up to 75, then it went down, and then it went really up in 79 and 80. But look at the M2 money supply. It just kind of went up gradually. And then the gold price fell from the 96. You could see in 96, it was about 400, and then it declined all the way to the beginning of the 2000s. But the M2 money supply continued to go up. And then we could see in 2000, it started to go up in 2005, and it really shot up in 10, 9, 10, 11. But look at the money supply. So we can't, some analysts are looking at the money supply as a gauge. I would say as you're adding more money supply, it's an indirect because there are more dollars out there. But we could clearly see these peaks in the gold price did not correspond with the money supply. So my analysis suggests there's a different driver of the gold price.
So on this, Steve, would there be a difference of using M1 versus M2?
I mean, there is a little bit of a difference, and then there's M3, and then there's the MZM. But overall, you can see that the gold price shoots up, and it has kind of these ups and downs, and it doesn't really correspond with the M2 money supply. But again, there is more money supply in the system, and so then there's more dollars in the system. But also there's more people. There's a heck of a lot more people in the system since 50 years, and we have to remember there's a lot of dollars overseas too. The euro dollar. It's not just the dollars that are in the U.S. There's a lot of dollars traded overseas. So we need to understand there's many dynamics. But again, to me, the M2 money supply isn't the real driver of the gold price. This is what I believe has been the driver, not only the gold price, but the silver price and the prices of most things. Because without oil, you don't have an economy. And because the energy always comes first. So this is the average annual gold price versus the crude oil price. Again, these are average annual prices from 1970 to 2022. And we could clearly see in 1970, and there's reasons for that. I don't have the chart here, but from 1961 to 1970, even though we had the Cuban Missile Crisis, and then we had the Vietnam War, the price of oil did not fluctuate. It was $1.80. But with all these major events happening like we're seeing now in the world, it didn't fluctuate because we were adding so much oil that was coming on from the Middle East. I mean, a big oil supply. But then the U.S. peaked in 1970, and the U.S. was the major oil producer in the world, in the 1910s to 1940s. And so we could see in the white line is the oil price, and in the gold line is the gold price. So there is a distinct correlation between the increase in the oil price and the increase in the gold price. Because if the oil price, we have to remember the oil price was like $1.80 in 1970. It reached $36 in 1980. It's up 17 times. So if the oil price is going to go up that much, the cost to produce everything is going to go up, especially gold and especially silver. So we can see that and then we had the price move up, and I'll get into that in a minute. And then as the oil price fell and remained in this trend, the gold price did too. And it wasn't until the oil price really took off after 2000, we see the gold price going up too. Now, it's not an exact correlation. They tend to, there's other factors. Also, it's the cost of production. But what's interesting right now, we see the gold price has trended above the oil price significantly. Because back in 2010, 11, 12, and 13, it was above $100. And this is the Brent crude price. It was above $100. Now it's only at 80 plus. And the gold price is really at an average annual high. So the gold price is much higher than the oil price as a relative term.
So, considering that point, Steve, do you think that it's possible that the gold price is at all overvalued?
Well, you see, we could talk about that for an hour. Right now, we'll get into that. The gold miners are making very nice profits. While many in the precious metal community can talk about, all the paper gold contracts being traded, there are speculators that are doing that. They don't have to do that, but there are speculators. And then there are the commercial short positions. And so there's a trading mechanism. But the reality is, if we look at the Dow Jones 30 industrial stocks, they all have margins. And guess what? The top gold miners actually have better margins than a lot of the Dow Jones industrials. They're making more money than the Dow Jones industrial stocks. Well, if the price of gold was really manipulated and the miners were not making money, I would say, okay, there seems to be a factor there. But the gold miners are making very good profits right now, and they're giving a lot of dividends. And so this is an aspect that the industry is kind of overlooking. But there are other dynamics we can talk at the end of this interview. But right now, the gold price, there are very good margins for the gold mining industry, and they did not have those several years ago.